Have you ever wondered why some people grow their money so much faster than others? Almost like they discovered some secret switch that makes their savings work for them? The truth is, there is a switch, and today I'm going to show you exactly how it works.
Hey, real quick, before we jump into the video, please take some time to read the full disclaimer on the screen.
By the end of this video, stocks and bonds will suddenly make sense, even if today they feel confusing or intimidating. And once you understand them, you'll look at money in a completely different way. Let's start with something basic. Companies need money to grow. Governments also need money to operate. And guess what? You can help them get that money. In return, they might help you grow your money too. The way they do this is through stocks and bonds, and these two things are the building blocks of almost every investment you'll ever see. If you ever plan on investing, or even if you're just curious about how wealthy people grow wealth, then knowing the difference between stocks and bonds is one of the most important things you can ever learn. People often hear the words stocks and bonds and immediately think, that's too difficult. But it's not. Honestly, if you can understand the difference between owning something and lending something, you're already halfway there. Let's start with stocks. A stock is basically a tiny piece of a company. When you buy a stock, you aren't just pressing buttons on an app. You're buying ownership in that company. It might be a small piece, but it's still ownership. If the company grows, your piece becomes more valuable. If the company struggles, your piece may lose value. It's that simple. Think of it like owning a slice of pizza. If the whole pizza gets bigger or more delicious, your slice becomes more valuable. But if the pizza burns, your slice isn't going to taste great either. That's how stocks work. The better the company performs, the more your stock is worth. If the company makes profits, sometimes it even shares some of that profit with you through something called a dividend. Not every company pays dividends, but many do. Now, here's the interesting part. Because you own part of the company, you also take on some risk. Businesses go up and down all the time. Some survive, some fail, some blow up and become massive successes. That's why stocks can rise quickly, but they can also fall quickly. That's why people say stocks can be risky. But that's also why they can offer bigger rewards. But what about bonds? Bonds are very different. When you buy a bond, you're not owning anything. You're lending money. Think of bonds like IOUs. You give money to a company or a government, and they promise to pay you back after a certain period, plus a little extra. This extra is called interest. If stocks are like owning a slice of pizza, bonds are like lending someone money to buy ingredients. They promise to pay you back, and usually with interest. Bonds are usually much steadier than stocks because they're based on agreements. Companies or governments must pay what they owe unless something goes seriously wrong. That's why bonds are considered safer. You might not make huge profits like with stocks, but you get more stability. And here's a question for you. Answer it in the comments. Do you prefer the idea of owning something that can grow big or lending money for steady, predictable returns? Which one sounds more like your personality? Now, let's go deeper into how these two things behave over time. Stocks go up and down a lot. They can rise fast, fall fast, and sometimes move in ways that don't seem logical at all. But historically, over long periods, stocks usually grow because companies grow. It's like riding a roller coaster that, even though it dips, generally climbs upward over the years. Bonds, on the other hand, are more like sitting on a bus that moves slowly and steadily. You know where you're going and when you're going to get paid, but the journey won't be very exciting. Most bonds pay you interest on a regular schedule, and then, at the end of the term, you get back the amount you originally put in. Now, here's something most beginners don't realize. You can mix stocks and bonds. You don't have to choose one or the other. In fact, almost every smart investor uses a mix of both. Some get more stocks for growth, some get more bonds for safety. It depends on what you want. If you're young and have time to ride out ups and downs, more stocks might make sense. If you want stability or are closer to retirement, you might lean more toward bonds. And that brings up an important question you can answer in the comments. What's more important to you right now, growth or safety? Another thing beginners often wonder is, can I lose money with stocks? Yes, but you can also gain a lot. Can I lose money with bonds? Technically, yes, but it's much harder unless the company or government issuing the bond fails. That's why government bonds are usually considered very safe. Here's something interesting. The government uses bonds to fund schools, roads, hospitals, and other public projects. So when you buy a government bond, you're actually helping your country function while earning something at the same time. It's like you're part of a much bigger system. Now let's talk about risk versus reward. Stocks offer higher reward but higher risk. Bonds offer lower reward but lower risk. It's like choosing between a fast-moving bicycle on uneven terrain versus a slow-moving car on a smooth road. They both get you somewhere, but in different ways. And remember this, every successful investor understands how to balance risk. They don't panic during stock drops. They don't expect huge profits from bonds. They know exactly why they hold each one. Understanding that is the first step to building confidence in investing. Let's break down an example. Suppose you invest $1,000 in a company by buying its stock. If the company does extremely well, that $1,000 might turn into $1,500, or $2,000, or even more over the years. But if the company performs poorly, your $1,000 might drop to $800 or $600 before recovering, or maybe it won't. That's the trade-off for higher potential returns. Now imagine you use the same $1,000 to buy a bond instead. The company or government might say they'll pay you 4% interest every year. That means you get $40 every year. Then at the end of the bond's term, you get your original $1,000 back. You won't wake up rich overnight, but you probably won't stress about your money bouncing around either. Here's another question. Do you like the idea of predictable income like the interest from bonds, or are you more excited by the possibility of growth like with stocks? Tell me in the comments. I love reading your answers. Now let's talk about something important. Time. Time is the secret weapon in investing. Stocks need time to grow and recover from bad periods. Bonds need time to pay out interest. The longer you invest, the more your money can grow, even if you start small. You don't need to be rich to invest. You just need patience. Most people make investing harder than it needs to be. The truth is, if you understand these two tools, stocks and bonds, you're already ahead of most beginners. They're like the foundation of almost every investment strategy in the world. If you ever hear someone talk about portfolios, mutual funds, ETFs, retirement accounts, those things are usually built with a mix of stocks and bonds. Here's a fun insight. If you wanted to build a simple beginner portfolio, you could literally start with something like 70% stocks and 30% bonds. This gives you some growth and some stability. As you get older or more cautious, you might change it to 60-40 or even 50-50. There's no perfect mix. It depends on your goals. Speaking of goals, here's another question for you to answer in the comments. What is your biggest financial goal right now? Buying a house? Starting a business? Retiring early? Something else? Now, before we go deeper, if you're finding value in this explanation and you're learning something new, make sure to like this video, subscribe for more simple and powerful money lessons, and share it with someone who needs clarity about investing. It really helps the channel grow and helps more people learn the things schools never teach. Let's continue. A lot of people think investing is gambling, but gambling is guessing. Investing is understanding. Stocks and bonds aren't magic. They're simply tools. Stocks help companies grow. Bonds help companies and governments borrow safely. And you get to decide how you want your money to work. Imagine you're building a house. Stocks are the parts that help you build higher, maybe another floor or roof. Bonds are the parts that make the house stronger, like the foundation and support beams. Both are important. Another thing beginners often misunderstand is that you don't have to pick individual stocks or individual bonds yourself. You can buy them through ETFs or funds that spread your money across many companies or many bonds at once. This helps reduce risk. It's like eating a mixed fruit salad instead of trying a single fruit and hoping it tastes good. But even if you invest through funds, the idea is the same. Stocks give growth, bonds give stability. Here's another question. If you had to create your own investment mix today, what percentage would you put into stocks, and what percentage would you put into bonds? Drop your answer in the comments. I'm really curious how you think. Now let's address something every beginner wonders. Which one is better, stocks or bonds? The real answer is neither. They're just different. Stocks are better for long-term growth. Bonds are better for stability and steady income. The best choice depends on you, your age, your goals, your risk tolerance, and your timeline. If you feel nervous watching your money move up and down, bonds might feel more comfortable. If you want higher long-term returns and don't mind short-term ups and downs, stocks might be your friend. And here's something important. You don't need to pick perfectly. You just need to start. Because even the smartest investors don't get everything right. What matters is consistency. As we come toward the end of this explanation, I want to leave you with a simple truth. Investing isn't about being the smartest person in the room. It's about understanding a few basic principles and sticking to them. Stocks help your money grow. Bonds help your money stay steady. When you blend them, you create something powerful, a balanced plan. So here's my final question for you today. After learning all of this, which one do you feel more drawn to? Stocks, bonds, or a mix of both? And why? Drop your answer in the comments. I love seeing your thought process. If you enjoyed this and want more clear, beginner-friendly videos on money, investing, and financial freedom, make sure to like, subscribe, and share this with someone who needs it. Thanks for watching, and I'll see you in the next video.